Welcome back to Intermediate Accounting. This is Chapter 15, and we're going to be covering something that we haven't talked about before in financial accounting, and that's leases. These are treated quite differently than anything else you've seen, so it's really important for you to follow through and understand everything in this chapter. So let's go ahead and talk about the two parties that are involved in a lease. So we have the lessor, which is the owner of the asset that is going to be borrowed by the lessee, who is the borrower. So we typically think of a lease as, maybe an apartment or a vehicle, but we also inside of business see a lot of leases when it comes to equipment. Even printer equipment a lot of times is leased by a lessor, by the business, from the lessee. So the lessor is giving up the right of use of that asset to the lessor over a period of time, and the lessor just makes payments to the lessee. Typically, it would be every month. What you're going to see in the accounting problems in your homework is going to be once a year. So that's what we're going to focus on when it comes to the lecture here. So there are two different types of leases, and it's the way they're classified based on certain criteria. So that's going to be one of the main things we cover in this first video. So for the lessee, we have either a finance lease or an operating lease. For the lessor, the owner, we have either a sales type lease or an operating lease. So it's going to fall in the same row here for the lessee and lessor depending on the type of lease. So if it's a finance lease for the lessee, it's a sales type lease for the lessor, and it may be with or without profit, and we'll see that as well. If it's an operating lease for one, it's an operating lease for both of them. So we are going to look into how do we test for whether or not is it a finance and sales type lease or if it's an operating lease. So let's go ahead and jump into those criteria. So a finance sales type lease has to meet one or more of any of these 5 criteria. So it doesn't have to meet all of them, it just has to meet at least one of them. So the first one is the agreement specifies that ownership of the asset transfers to the lessee. So in other words, it's like a rent to own. So they might have this printer equipment for now and they're going to be leasing it for 5 years, but at the end of the 5 years, it is going to then be the lessee's property. So if that is specified, it would be a finance sales type lease. If the agreement contains a purchase option that the lessee is reasonably certain to exercise, and we call this the bargain purchase option. So in other words, at the end of the lease, they have the opportunity to purchase it, and a lot of times it is at a bargain price, and they are very likely to exercise that. If that's the case, it would be a finance sales type lease. The lease term is for the major part of the remaining economic life of that asset. So what you'll typically see in your homework is that it's for the entire time. So that's the major part of its life. So if it is only for, 3 out of 6 years of the asset's life, then no, it wouldn't qualify for this because that lessor could lease it out to someone else or get use of it themselves. But if it's for the major part of the life, then the lessee is pretty much going to be using up the asset until it is, not useful anymore anyway. If the present value of the lease payments equals or exceeds substantially all of the fair value of the underlying asset. This one's going to be one that we focused on a good bit here. So the present value, which is actually calculated slightly different for leases, if the present value of all of their lease payments, remember we've looked at all these calculations of present value, if it equals or exceeds what the fair value of the asset is. So we'll be given the fair value, and then we have to find the present value of the underlying asset of the lease payments to see if they are equal or more. The underlying asset is of such a specialized nature that it is expected to have no alternative use to the lessor at the end of the lease term. So, okay, we are just leasing this to you, but no one else is ever going to use this. This is a giant, donut-shaped icing machine, and we made this just for your donut shop. No one else is ever going to use this. If that's the case, then it qualifies as the finance sales type lease as well. So if you kind of look at all of these, it's basically if the lessee is going to be the only one using this asset for the rest of the time, then it's pretty much a finance sales type lease. That's kind of what sums these up. So let's start with a new case study for chapter 15 for our leases that we'll be following throughout the chapter. And then we will jump into looking at those five criteria and how it applies. So we're going to look at Harvest Pro Farms. So we're going to look at this farming company that's going to be leasing some equipment. So Harvest Pro Farms case study, we have that they need new combine harvester machine. Instead of purchasing, they sign a 4-year lease agreement with AgriLease Corp. The fair value of the harvester of that machine is $263,493. The annual lease payments are $55,000 due at the beginning of each year. The lease term is for 6 years, so they're making 6 of these $55,000 payments. The useful life is 6 years. The interest rate implicit in the lease is 10%, so that's what we'll use for calculating the present value. No purchase option and no transfer of ownership has been agreed upon. So how would this lease be classified? Maybe you want to take a screenshot of this. Maybe you want to pause it and jot down all the notes or take a picture with your phone. But this will be what we'll be using throughout with Harvest Pro. All right, so you ready to jump in and see, first of all, what is the present value of their lease payments? So what we do, as usual, is we take the lease payments, like we've taken other payments for bonds and for loans. So our lease payments are $55,000. And we multiply it times our present value factor. But here's what's different for leases typically. As you saw, let me go back one slide here. The annual lease payments are due at the beginning of each year. Now, when we've done present value and present value of an annuity, an ordinary annuity, the payments were due at the end of each accounting period. Here they are due at the beginning. That's how most, leases work, right? You go ahead and pay up front for the rest of the month or the rest of the year, or whatever it may be. So that's what's happening here. They're paying at the beginning. So that changes things up when it comes to our present value. So we can't use just the regular present value table because this is multiple payments. We can't just use the present value of an ordinary annuity because that's when the payments are made at the end of each year. Instead, we're going to use the present value of an annuity due. So when you see annuity due, that means the payments are being made up front. So the first payment is actually made the first day of the lease agreement, just like you would do with a car or an apartment, right? You make that first payment on the first day you're using that asset. So that first day when the lease payment is made, this is going to take that into consideration, and it's going to take it into consideration that every payment after will be at the beginning of each accounting period. So you have to use present value of annuity due when you're doing lease payments, as long as it says that the payments are due at the beginning. So when we take our $55,000 payments and we go to the present value of annuity due, the PVAD table, and we go to 6 periods because it's 6 payments, and they told us it was a 10% interest rate, we get the factor 4.79079. When we multiply that, it tells us the present value of our lease payments is $263,493. So now we found the present value. So let's look at the 5 criteria to see how this lease is going to be classified. So first, does the agreement specify that ownership of the asset transfers to the lease? Well, if you took a picture of that slide that had all of the terms, we saw at the very bottom, no, it said there's no ownership transfer at the end. So that is not met. So that would be a no. Then we go to the second one. Does this agreement contain a purchase option that is reasonably certain to be exercised? And no, it said there is no purchase option that they agreed upon. Number 3, is the lease term the major part of the expected economic life of the asset? On this one, it's a big yes, because the lease term is 6 years and the asset is expected to last for another 6 years. So basically, Harvest Pro Farm, they are going to be leasing this asset for the rest of the time that it's useful. Number 4, is the present value of the minimum lease payments equal to or greater than substantially all of the fair value? Well, we just calculated that the present value was $263,493. And if you recall, the fair value was the exact same amount. What are the odds? So that would be a yes. And then if we look at number 5, does the asset have no alternative future use? It doesn't tell us that, but we only had to meet one of the 5 criteria. So really we could have stopped at number 3 and said, oh, this is clearly a finance sales type lease. So it does meet at least one of the 5 criteria, so we know how to classify it. So it's a finance lease for the lessee, for the borrower, and a sales type lease for the lessor, for the one that is the owner of the asset. Think of it this way. The lessee is the one borrowing it. They're the one financing it. The lessor is the one that's basically selling it. And the reason they call it this is because it's a sales type lease, because they're basically selling it. They're using it for the rest of its life, and it's to the same present value as the fair value. All right, so we go back to our situation here. We've got all the same things, and we're going to start looking at how to account for this. So since it is a finance sales type lease, because that's what we're going to focus on in this first video, we are going to first record for the lessee. The lessee is going to record an asset, a debit to the right of use asset, and that's going to be for the present value of the lease payments. So this is a new asset we've never talked about before, but it is the right of use asset. And then they're going to record the lease payable. So it's for the whole amount of the present value of the lease payment. So that's how they would record that. All right, now let's look at how the lessor would record it. So the lessor is going to show that they have accounts receivable for the present value of those lease payments, and they're going to show the equipment is leaving their books. Now, this is only going to happen when it is a finance sales type lease, because they're basically handing over their equipment. There's going to be no use for it afterwards. So they're going to go ahead and take it off the book for the carrying amount of that asset. Then when they make the lease payments, that's when we start seeing all the math coming into play here. So the first lease payment is on the very first day of the lease. So because of that $55,000 lease payment, there is no interest that is accrued yet. That's a really tricky thing about leases that are not like any of the other loans or the bonds that we've looked at before. So the first lease payment is on the first day of the lease. That means all of it goes straight towards the principal of the loan. So for the lessee, we're going to reduce the lease payable by the full amount of the payment, and we show that cash going out. There's no interest included here. For the lessor, same thing. They got the cash coming in, and their lease receivable goes down by the full amount of the payment. Since not a single day has passed, that means there is no interest involved. So this might sound really clear, but sometimes it's really hard to remember this because we've never done loans like this before, where there's no interest when they make the first payment, because they don't typically make the first payment on the first day of the lease, or the loans that we've looked at before. With leases, they typically do. Then it gets trickier when it comes to the second lease payment, because now we need to consider how much is still owed. So we're going to look at that lease payable, we'll look at the lease receivable, and we're going to calculate interest based on that, considering that the whole first payment went to paying down the principal. So, and you can keep a T account of this as well, and that's always a fantastic way to do it. So we started with a lease payable of $263,493. Then we subtracted the full $55,000 payment since there was no interest in that first payment. Then we multiply that times the 10% interest to get our interest expense for the second year, for that second payment. And that interest was $20,850. Then we know the cash payment was $55,000. So the difference is what we're reducing lease payable for. And it's the same thing, just opposite for the lessor. They're getting cash in of $55,000. They calculate the interest revenue the same way we did above, but I'll repeat it just to make sure you're understanding. And we're going to see an amortization chart that can help as well. So they take the full amount of the present value, the $263,493. Then they subtract out what's already been paid down on the loan, which was $55,000. So that's the remaining balance of the loan. Then they multiply that times 10% to get the interest. The rest of it's going straight towards the principal of lease receivable. This is how, loans work. As you pay them down, the principal is lower, so then the interest is always based on the amount that is still owed. So as you pay it down, there's less and less interest, and that's exactly what's happening here. So let's look at it under an amortization, because sometimes that can help us understand things better. So we started out on January 1st, 2026 at $263,493. Then that same day, we made that payment. So all of it went towards the balance. So instantly, we've paid it down to where we only owe $208,493. It's kind of like a down payment, right? That we would think of with other types of loans. So then on that second payment, the one we just recorded, one journal entry before, one slide before, we take the $208,493, what's left over in the outstanding balance. We multiply that times the 10% to get our interest. And then the difference between our cash payment of $55,000 and that calculated interest is the decrease in the value. So now we're at $174,342. And we just keep doing that. We take the outstanding balance times that 10% to get our interest. And the difference between our cash payment and interest is how much is decreasing the balance. And we do that until we get all the way down to zero. So at that point, they've made $330,000 in payments. We see there on the left, the bottom left, and that included interest, right? We know that the asset was only valued at $263,493, but they had to pay interest. So they paid $330,000 total, but $66,000 was interest, and then the $263,000 was paying down the balance. So you can do that this way. You can do this in Excel. You can do this with a T account and keep up with it. I would maybe do it all the different ways to help you understand the process, and I think that will help you be successful. So when it comes to the amortization of the right of use asset, so remember the lessee has recorded in a finance sales type lease, they have recorded that there is an actual asset. It is the right of use asset. Well, they are actually going to amortize that as they use it. So like in this case, they've got 6 years that they're going to get use out of it. So they're going to amortize it over the 6 years. So the lessee incurs an expense as it uses the asset, similar to recording depreciation expense whenever they purchase an asset. It allows management to match the expenses of the asset with the revenues that it's assisting in generating. So we want to make sure that we are smoothing this over time, and we are showing that there is amortization of this asset, even though it's a lease, because it is a finance sales type lease. So we just take our lease and we are going to divide it by 6 years, the present value of the lease, divided by 6 years, and they amortize that over the 6 years. So here they debit amortization expense, just like you do with intangible assets, and then we credit the right of use asset. So by the end of the 6 years, we've also gotten the asset off of our books through amortization. So they're making, for the finance side, for the lessee side, they're making a couple of different entries. They are going to make the entry of paying out the cash, paying for the interest, paying down the loan, as we saw on the last slide, and they're going to be amortizing the asset at the same time. So it would be the same way if you had taken out a loan and bought an asset, right? You'd have one entry to be paying down the loan and paying interest, and then you'd have another entry to be recording depreciation. So a sales type lease with or without selling profit. So with selling profit. So this takes place when the fair value of the asset exceeds the cost of the carrying value. So we have this asset and it's worth more than what it's on the seller's books for, or the lessor's books. So the lessor is going to recognize selling profit at the beginning of the lease. So if there is profit, they're going to recognize that right in the beginning as soon as they hand that asset over. And we're going to look at this as well. The lessor also recognizes interest revenue over the lease term, just like we saw it before. Selling profit is calculated as the difference between the sales revenue and the cost of goods sold. You're used to this with other types of inventory, so let's look at it with a lease. So we've got the same situation here, except the big difference is the carrying amount for the lease. It's not 263,493, it's just 200,000. So the present value of the lease payments is 263,493, but the carrying amount for agri-lease is 200,000. So there's going to be some profit there. So that's what we're going to record next. So we've got the revenue, the sales revenue coming in, the money that they're going to be getting from these lease payments, the 263,493, the present value of the lease payments. The cost of goods sold is the carrying amount of the asset, which was 200,000. So the difference is going to be recognized as selling profit right up front. So for the lessor, the owner of the asset, we are going to see our lease receivable is going to be the 263,493, just like we saw before. But we are going to record a cost of goods sold if there's going to be profit. So we debit cost of goods sold just like we would do with inventory. And then, and I apologize, these have gotten off a little bit, but the bottom two are both credits. Sales revenue is going to be credited for the full amount of the present value of the lease payments. And then we get the equipment off the books for the carrying amount. So it's just like when we've seen this with inventory. With inventory, we make it in 2 entries, and you could make this in 2 entries as well. In fact, your homework may ask you to make it in 2 entries. If that was the case, you would show lease receivable and sales revenue, just like when you sell an asset and you have accounts receivable and you sell inventory and you have sales revenue. Then you would record cost of goods sold, and then you would be crediting inventory. Same thing here, cost of goods sold, but it's more significant than inventory. It's a whole piece of equipment. So we're just recognizing profit, and this is only for the lessor. All right, so what does the first lease payment look like whenever it is a sales type lease with profit? So we just saw what it looked like to go ahead and record the profit. But then after that, it just looks the same. So the first payment, which is made on the first day of the lease, is just going to be cash coming in for the payment amount, and then the lease receivable decreasing. And then the lease payments after that, just the normal way with the interest. Nothing has actually changed except for that very first entry, and that's only for the lessor because they're the only ones showing any profit. So no interest at this point, but they would in the future payments. So the accounting treatment, when selling profit exists, the only difference for the lessor is the initial entry to record that profit. All of the subsequent entries are the same as they are for the sales type lease without profit, the ones we saw first. For the lessee, accounting is unchanged. Entries are identical regardless of whether or not there is profit because they're not having to show anything. They would show exactly what we saw whenever we looked through their entries before when there was no selling profit. Nothing's changed for the lessee.